Hey, it's time for another edition of the Un-F Your Finances podcast with your host, Nick St. George. I'm your podcast producer, RJ Malik. Nick, how you doing today?
Hey, RJ. I'm covered in pollen from head to toe.
Oh, boy.
It's the yellowing season here in North Carolina where your car, everything.
Yeah.
I have contacts, like you go outside for an hour or so, like you can, like by the end of it, you can feel like the grit, like there's almost like sandpaper, like it's just stuck in you.
Sure. I'm fortunate. I don't have allergies, so I've never been bothered by that. My brother is the same way you are as far as not, getting allergies and just not reacting well to pollen.
I didn't have allergies until I moved to the South. Rhode Island has pollen for a little while. It's just lovely and different. Thank God it rained a little bit today. Maybe I won't die. I get the debut of football coach Fluffy. So I get flag football tonight since I retired from baseball. We'll see how that goes.
That sounds good. And today we're going to be talking about taxes. So what do you got lined up?
Hey, we've talked about tax a couple different ways, but this should be airing a little after around April 15th, which is your tax deadline. And most people think that's your end of tax season. Like, hey, you start getting your W-2s end of January, February, and then tax season ends in April. But if you wait until tax season to talk to your CPA, that's like the great Stuart Scott used to always say, hey, that's a 6-4-3 double play for you scoring SportsCenter highlights at home. If you're keeping score after the play already happened, you can't make any changes. And effectively, tax planning for 2025 starts now. So you have to be proactive, anticipate things, and kind of right now, here's your reflection moment. Like with my clients, they're going to start getting email links to Halistaplan for them to upload their 24 tax return. And we're going to do that postmortem. What's changed from 23 to 24? And how can we make some tweaks in 25 to keep Uncle Sam's hand out of their pocket and be the most effective with withdrawals? And just where do you put your 401k contributions? There's so many different things, but you can't wait until January or February. I know I said before you need the flux capacitor with your DeLorean to change things, but no, this is it. Like you have your tax return, and we'll also hit on a couple things at the end, like if you filed an extension, because that's possible. Like maybe you don't have everything in, maybe you got some partnerships. Those K1 forms can take out forever. Like I know some people that have a lot of partnerships. Like they just know, hey, I'm going to file an extension. This probably won't get done until September. No big deal. But so we're going to talk through some of those things you can do now that, hey, the dust is settled. Do you owe Club Fed? Do you get a big return? And anything in between.
Okay, so I see here the first thing you have on your notes here is reassess withholding and estimated payments. So walk us through that.
So a lot of people, if you're a W-2 and you go to work and you fill out your W-9 and your payroll and your HR benefits and all that stuff, and you're like, hey, I'm married with 2 kids. So you fill that out. What happens there is they just look at that in a silo. So your payroll system, whoever it may be, they're going to look at, hey, this is all the income you have. But let's say a spouse has a high earner or you have other income that you're not withholding taxes from. You might need to, you might need to claim single zero. Even if you're married with 3 kids, you might need to adjust or you need to withhold from other areas. Run into a couple different ones on this one. People that don't withhold anything on Social Security. I know that's one of those promissory ones on the election and everything like that. They may stop taxing it. It has always been a little weird to me. Like you pay into Social Security and they're giving more or less your money back. And now that's taxable. Like it's usually, not nearly as taxable as regular income, but that's getting a little more in the weeds. But if your spouse, a lot of people nowadays, both spouses work to some extent. So if one makes a good bit of money and the other one does not, those payroll companies don't talk to each other. They don't realize that maybe household income is $400,000. They're going to look at that one is 300 and one is 100, and it's in a silo. And you come tax time, it's like, oh wow, I have an underpayment penalty, and suddenly it gets a little tricky.
I've lived through that because my wife and we have 2 separate jobs and we work for 2 separate companies, and for a number of years we just got slammed, and it was just very frustrating.
And typically by the time you realize this is like March, you get like the little love note from the CPA. Hey, this is, do you have any like receipts from Goodwill? Like the random, like, did you have a child you forgot to tell me about? Like, does your dog have a Social Security number? Like yeah. You start worrying about like, hey, because typically, oh, you make an IRA contribution is a little too late or just not enough to offset when you're like, oh shit, like this is I'm never gonna financially recover from this. Remember that? It was like 5 years ago when that was a popular phrase, all the memes and the
Yes.
um but there's a free calculator on irs.gov, talk about tax withholding. You can talk to your CPA and say, hey, looking at all this, if nothing changes, what can I do differently for 25? With my clients, we're going to look at the holistic plan report. Where can we pinpoint? Did you get a big bonus? Did you sell a property? Like, was there one off that caused a headache? Or is this the new normal for you going forward? And this is things you can start changing now. All right. Hey, you were putting more money in the Roth 401k side, maybe because of where you're at tax wise, might be a little more helpful to throw it in the deductible 401k side versus the Roth. And those are the different conversations that are Google can't figure out your tax return and tell you which bucket the money goes to. This is where that whole knowing where it works for you, not your neighbor's plan or whatever else that is, but understanding where you fall on that. And that's the downside of like a basic, like the free processor, right? Because it's just a post-mortem. They're uploading data, they're scrubbing it into their form and spitting out an output. They're not saying, hey, you need to do a quarterly payment or you're going to have an underpayment next year. Like they might give you a quick little high level blurb, but they're doing tax preparing. They're filing your taxes. They're not doing tax planning. That's a whole nother step in the process. Not saying CPAs won't do that, but this is the problem of tax planning for 25 really starts April 15th to December 30th.
Okay. So the next step you have here is maximizing contributions to tax advantaged accounts early. You're talking to me. What do you mean by tax advantaged accounts?
Tax advantage accounts. So when you think about it this way, when you make a gain in there, do you have to go file it with the Club Fed? Does Uncle Sam get a piece of, you have to pay capital gains on that? So your college savings. So think about your 529 or Coverdale. You could trade it till you blue in the face. There are no capital gains. You only pay, there's only a taxable event when you take money out, and it's tax efficient if you're going to pay college related expenses. Same thing in your IRA. So, but if it's a taxable account, so say your joint account or your individual, the one you've been messing around chasing some of those Mag 7 stocks and you messing around, oh, I can't lose, just like my DraftKings account, those get reported. You get that 1099 showing capital gains, capital losses, short-term or long-term. That's taxable. So you're tax efficient in your retirement accounts, your education accounts. You can, most HSAs, typically there's a threshold. Let's say it's 1,000 or 2,000 you have to keep on cash. Anything north of that, most of those HSAs let you kind of invest it. Think about like your 401k. They'll give you like 10, 20 options to put your money to work, but they'll make you keep cash knowing that, hey, you're going to go to the doctor. You might have a prescription. You might have some eyes. So they're going to keep a cash buffer. But once again, that's a tax efficient one. Those trading, those gains in those accounts don't count for anything. Now, on the flip side of not counting for anything, if you're going to take a chance, if you're going to buy some crazy startup that your neighbor said can't lose or do anything goofball like that, I typically tell people at least put it in a taxable account, because if you blow up your IRA, you can't deduct that loss. At least if you deduct the loss in a taxable account, you can get credit for being an idiot or taking a chance. Your IRA, there's no, hey, sorry, you're going to deduct this out. Years ago, there was a little bit of a loophole. They closed that since.
Okay. So you take that money out separate. You don't. So what you're saying is don't touch the IRA.
You don't want, you like, hey, life is perfect. You're going to wait until you're 65 to start hitting your IRAs, or after 59 and a half is when the penalties, any early withdrawal penalties go along. But hey, what if you lost a job? What if you were in a bind? Yes, you might have to dip in the IRA, but the yearly trading, you're rebalancing. So if you look at my portfolios, retirement accounts, they'll at least get a quarterly rebalance, or if there's a dramatic change in the data from Helios, you might get some mid-month. I'm going to do those in the retirement account. There's no question to ask. Your taxable accounts, hey, I'm going to call you. Hey, what's income look like this year? Do we have any wiggle room to have some cap gains come off? What's going to happen? Let's look at your holistic plan report. I get some clients that make 7 figures in W-2 income. Hey, can we wait on touching the taxable account? We'll get there. And right now we get the start of the year a little choppy, and I'm going to sell some losers to give me some carry forward losses. And then that way I can sell some winners and get you back in line. Try to minimize that tax bill. There's been floating around LinkedIn a couple of stories that, hey, I got a new client. They don't know why, but they have $280,000 of capital gains. They have no idea. There was no conversation, and now they have a tax nightmare. Like, that's the difference between a retirement account, which is deferred, tax efficient, or tax advantaged. You're going to pay taxes eventually. Uncle Sam's going to get his piece of the pie one way or the other, or the ones you get to report annually, like your taxable account. So that's a big difference. That's one of those things that people forget as the year's going along of, oh, that's what you'll hear. That's another reason why people say January can be a little bit of a crazy month. If you're going to realize capital gains, wouldn't you rather have that cash flow for 13 months? So people will sell in January knowing they don't owe that bill. For instance, if you sold in January 25 in a taxable account, you technically won't owe those capital gains to Uncle Sam until April of 26. Versus if you sold in December, you would owe in April 25, like basically 4 months later. So, hey, can you make it to January to do this?
Okay, so there's a strategy to moving your money around.
Correct. And that kind of takes us into that next one, is that portfolio rebalance. What does the tax look like? Can we incur some capital gains? Or, hey, there's a couple of things we really need to change. This is going to cause, we're going to have a conversation in the front end. So in the back of your mind, you're not finding out from your CPA that you have cap gains. Like, it needs to be a discussion on the front end. You shouldn't get a surprise tax bill from your advisor.
So, okay. And what I'm getting from you as I'm listening to you speak is that you should not be like me, who speaks to his financial advisor once a year at tax time. You really need to step up and maybe quarterly just touch base with your financial advisor.
Look, I send out emails every other week, every 2 weeks. Now, I call them bathroom reads. Like, if you can scroll on your phone, like one scroll at max, very high level, just to keep you informed. Like, I'm not getting the weeds and the buzzwords because the noise in the market, like I'm not in the business of selling advertisement. I'm in the business of getting to your goals with the least amount of risk. Like, right. I want to get you to wherever you want to go.
But it takes two to do that. That's sort of what
Correct.
I'm saying.
So every email I've ever sent has a calendar link to me that says, hey, book some time. Like, if something's on your mind, because on the flip side, I don't want to call you in the middle of, you're working 9 to 5. I don't want to just call you at 3 o'clock because it's convenient for me to talk to you about it. It's your money. Yeah, I'm working for you. I'm trying to help you. But so I'm going to try to keep you informed. We get the podcast, we get some other videos. I'm giving them content and trying to just educate them. Like, this too shall pass. Like, yes, I sometimes, I feel like I'm Kevin Bacon in Animal House. Remain calm. Like, and it's sometimes difficult in all of this. I joke that I should have like a voicemail before you talk to me. It's like, press 1 press 1 for this news network, press 2 for this network, press 3 if you voted for this one, press 4 for inflation, press 5 for tariffs. And I'll give them like the quick little thing, and then we can talk, like, because you're not alone. Like, the headlines, it's not always fun, right? Even my kids see the ads and hear the noise and they're like, what does that mean? And that sort of thing. Like, and we're going to have to pay more for my baseball glove. And it's like it's just, it's stuff like that. So noise is loud, but I try to do 2 bigger meetings, or at least scheduled. Give me at least 20 minutes, because sometimes things are fine. Hey, we're going to go through it. Hey, a holistic plan, income's about the same. We can do X, Y, or Z. 20, 30 minutes, just checking in. Because I'm not going to sit here and be like, the S&P did 6.2%. The beta is this. It's like, what does it mean to you? What is going on in your life? Are you thinking about switching jobs? Are you trying to retire a year earlier? Are your parents sick and you need to help them? Like, your kids need a victory lap in college. Like, there are other things that are important to you. Let's talk about those.
That's very timely for me. I've got an 87-year-old mother that I'm, watching and making sure she's doing what she's supposed to be doing. And, that's stressful, and it takes away from what I need to do. And, my mother-in-law, same age, same issue. So my wife and I are distracted. Life happens. So I guess what you're saying, it's really good to get in the habit, and you have to develop a habit of reaching out to your financial advisor and saying, okay, here's what's going on in my life. This is what we're spending money on.
And they're going to get annoyed with me because starting basically April 15th, I try to do that first review is April 15th to Memorial Day. Because you just got your taxes done, more than likely. Let's fingers hope you're not filing an extension.
Right.
And anything after Memorial Day is a shit show because it's traveling, vacation, graduations.
Yeah.
And you're no school's out for summer, right? And you might talk to me once or twice if something like big happens for you. So I try to do that right now in the beginning of the year. Everyone's like, all right, let me find all my documents. It's a scavenger hunt of W-2s or your HSA or
Yes.
do we still have the account at that other place? Like, so by April 15th, you start that. They're going to be, hey, schedule your time. Even if it's 30 minutes, even if nothing's changed, schedule your time, upload your Holista plan. Let's make sure we have the initial game plan. Then fast forward, we do the October 15th, which is the end of extension time period, to Thanksgiving. Because anything after Thanksgiving is also a dumpster fire. You have holidays, travel, parties, your kids' school events, and you got to like help with the PTO, and you got to do this, that, and this day is this theme, and it's like, and you have work deadlines. So that's why that's the thought process. Those are those two windows. I'm going to, Mr. Holland's Opus, banging you over the head. Let's talk. And the wonders of technology, it can be a quick Zoom. It could be a phone call,
right?
Like swing by the office, whatever, pick your poison, but let's schedule the time. Like, I don't want to jump out of you if you are in a work meeting. Like, that's why I give full access to my calendar. Go on there. Where's the time? And if you're a client and you need, hey, Nick, I can only do nights. What do you have Wednesday, Thursday? All right, fine. I can do after 8, kids sports, hey, I can squeeze you in here then. I don't leave the calendar open until 10 o'clock just because, hey, it's 9:45. Let's see what Nick's doing.
Okay. So moving on, and your notes are here, and you have your next topic, which is evaluate tax efficiency of investments. So how does that process work?
So I don't know. Years ago, I used a lot more mutual funds. They're pretty easy to get in and out of, but mutual funds can have gains even on years they have losses because they're such a big pool and the way they're treated for taxes. Over the years, I've more gone to what they call ETFs, exchange traded funds, or the individual stocks, because you control that trading. For instance, most of my taxable accounts, they got dividends and interest we may not have traded last year. They did not want any taxable income. So we didn't have any cap gains. So if you have that sort of thing, it's you got to know what you own, right? And those less tax efficient vehicles, maybe we put it inside that IRA. That goes back to, if you're going to take a chance on something, and take a lottery ticket in your portfolio, doing your taxable account, and some of those other things that may potentially kick off a K1 or something weird like that, maybe you put that in your IRA. But that's one of those things that you need to know what you own. That's where sometimes when the do-it-yourselfers get kind of punched in the mouth, they didn't realize what they were putting in what account and why. So just being more tax efficient to it. Or another thing, people talk about, hey, muni bonds are great. They got the tax efficiency. If you're at a 12% tax bracket, it doesn't quite make the same sense as it is for somebody in the top marginal tax bracket. Like, the concept is great. Oh, this is tax. They always talk about the tax equivalent yield. So that's like the buzzword on a municipal bond. But that's assuming you're in the highest tax bracket. If you're making less than that, let's say you're making under 100 grand, buying a muni bond probably isn't the greatest idea for you, like, because of the tax benefits of it. So that's one of those things. Or here's another great one. This takes me back to my call center days. Person is self-directed, so that means they're in charge of all their own investments. They were buying treasury bills in their IRA and were absolutely ripshit that they had to pay income tax when they took money out of their IRA, because they were buying treasury bills in an IRA and they were always told that was tax-free. And of course, they're yelling up, down, left, and right. And it's just like, you chose to do it yourself. It is the cheapest way, absolutely. But you took buzzwords, and that tax law is not going to work. Club Fed is not going to play along. That just because you bought T-bills in your IRA doesn't make the money coming out of your IRA not taxable.
So that's where communication is important. And for a person like myself, I would be considered a pain in the butt client because I don't pay attention. And I work, I concentrate on my career and other things, family issues. And, as far as my finances and taxes are concerned, I worry about it close to tax time and I don't think about it until afterwards. So,
I'm not saying you're going to worry about it every day, but one of the problems that we run into is you get all these invites and all these other questions and proactive trying to get a hold of you. You don't want to return the call. The only time it's suddenly important to you is, hey, I need to get money out and I need it yesterday.
right.
And suddenly I'm expected to drop everything and try to get this done out.
Yeah.
And my thing is, you knew you needed this money 3 months ago.
Right.
And one of those times I asked you to talk about needing money or if anything has changed with you, you blew me off. And now, for instance, let's say it's the last couple of weeks where the market's choppy. My hand is now forced. I don't like to try to sell into a down market if I don't have to. And if we know we have a cash need in the next 12 months, we would have that in some type of short-term, like interest-bearing money market plus, right? I'm not going to put that in some growth fund that, yes, could it go up, but it could also go down. You can't gamble with short-term money. I'm an investment guy. I still have cash. I have mortgage, debt. I have the business to run. Not every dollar is invested. There's certain money you just can't take risk with. And when you don't communicate that you have an upcoming need, your house needs a new roof, you might be out of a job and needing income. These things, when we're asking, hey, any changes? What's going on? Let's have that strategy meeting with each other. That's the time. Don't be embarrassed for it. This is the circle of trust. We're in the trust tree, right? We got the
Right.
even if I tell a story in the podcast, I'm never going to tell somebody's name, be like, oh, the Joneses did this.
Right.
And it's just more of one of those things that not looking at it every day and not communicating every day. You can't tell me, oh man, I got stuck in traffic today. It sucked, Nick. I'll call you tomorrow, let you know how it goes. Hopefully it's better. It's just more of, there are bigger things, right? Like, there shouldn't be surprises both ways. I try to communicate, hey, there might be a portfolio change, or hey, there's a lot of headlines right now. This is, put it in perspective. You're trying to talk through it. But if you're about to lose your job, hey, get on the phone with me. What's going to happen? What are your options?
Right. Well, and you were just mentioning changes, and that leads into the next topic you have here, understanding new tax changes. So why don't you go over that?
Yeah, tax changes happen roughly almost every 2 years, it seems like. A couple of years ago, they didn't clarify some of the tax changes until like December 23rd. Like Congress makes rules, like I did my homework in college. Like it's 2 a.m. We got to get it done. Let's just bang this out. So, hey, we just got through an election cycle, a lot of headlines, a lot of noise. You get the big tariffs, taxes. There's a lot of unknown. That's some of why we see some of the choppiness. We don't know. So one of those things is, hey, what is that going to really look like? What is the headline? The devil's in the details. Like the headline's one thing, but most people just see the headline. My mother's guilty of this. She'll see a headline. Oh my God, that must be awful. And it's like, did you click on it? No, I saw the headline. And it's just like, and that's every couple of years, there's a little bit of change. Like the estate exclusion. Now it's what, 13, 14 million for a married couple. It used to be $1 million. So you see like these people in the 90s when it was a much lower number, they have all these weird trusts that they did because that was the rules back then. And now the rules have changed and evolved. And I don't know, I hope to have that problem of having an estate of over 14 million, but not many people run into that problem.
Right? It's a nice problem to have.
But yeah, it's a great problem to have. And you like, they talked about it like during the financial crisis, they got rid of the estate tax. And George Steinbrenner, I'm a Red Sox fan, so screw the Yankees, but he was lucky enough to die during the estate. When there was no estate tax. The family said that if they actually had to pay that bill, they would have had to sell the team. Wow. Because it was such a big number and how the team was set up. And it was just like one of those things like, I don't know, that they smother him with a pillow because they knew what the tax ramifications were going to be. But it's stuff like that. There are changes. Yeah. What worked in the 90s doesn't always work now. Like rules have changed. And you have to, once again, find out what the rules change are, not just the headlines. And how does it affect you? If this is a rule change for a business that's for 500 employees or more, and you're in a business of 10, that's not a rule change for you. The headline may seem scary, but is it really a problem for you?
Okay. And that leads me to the next topic you wanted to talk about. And we're talking about filing an extension. That's something that I've never, I did do that a couple of years ago because I had some health issues. But it's something I really try to avoid. Is that a good thing, or filing extension depends on circumstances?
It's circumstances. It's not the dirty E word like everyone, oh my God, like, oh, file an extension. But sometimes, hey, more complicated. If you're in a partnership, they have what is called a K1. A lot of times those take very long to get filed properly. And like, I have a neighbor, his business is set up, they're a partnership. He knows he's not getting his K1 until September. Like, it is what it is. This is normal status quo. Now, if you've always just lived off of W-2s and 1099s your whole life and suddenly got one K1, you're like, I got to file extension. What is going on? Like, you're those people that was like January 8th asking me for their 1099. It's like, calm down. You can't even file yet. Like, take a deep breath. It's going to be okay. And an extension's not the end of the world. Now, years ago, it had been with lower interest rates, it wasn't as big of a deal as owing money to Club Fed. Now the interest rates, I think, float around 7 and change. Like, it's an actual, it used to be like 1 or 2. And you're like, all right, whatever. I'll give them their money eventually. They can wait for it. Like, but filing that extension. But for businesses, like, you might still be able to fully fund your SEP. You get the extended and you get all the numbers crunched. You can do that. And the other thing is, like, make sure, like, you've talked about, hey, where should I put this? Am I better off jamming in a SEP? Am I better off just saying, hey, I'm going to take it on the chin for this year and we're going to reboot this for 24? Like, that's that two-way street with your CPA. Now, if you did proactive tax planning in, I don't know, October 24, you're probably not going to be as surprised that you might need an extension, that sort of thing. But an extension is not the end all be all. It's not a bad thing. You just got to be aware of maybe why it happened, right? And use that extra time. If you get an extension, hey, let's make sure I didn't forget something. Every now and then you'll be like, oh, the spouse had, one of my marketing groups, the guy told the story, husband and wife did their finances separately. Husband was fully funding a Roth every year, even though the combined household income was like $700,000 for like 5 or 6 years. Didn't tell the other spouse, and they had to do back, like, it's a mess. Like, you forget to tell, oh, I had this form here, form there. Make sure you do your scavenger hunt of 1099s. You got to have that, like, healthcare one showing you have health coverage all year, all that fun stuff. Like, make sure you have everything. And because what is it? Anthony mentioned in that previous episode, like, they're going to be like, to my best of my knowledge, right? They're going to cover their ass that you gave them everything, and they're going off of what you gave. Their out is that you didn't give it to them.
All right. And I see here the next item you want to talk about is organized documentation and seek clarity.
Yeah, like, why do we need an extension? Was it that you took too long getting your documents? If you go give your CPA documents on April 12th, that's on you. If you had everything into them by March 1st, were they that busy? Was it more complicated? Like, what could you have done differently for your CPA? Mark sends me my packet, and, like, it's a data upload. Like, and his is nice because it recognizes, like, it'll ask me, hey, what about this account? You uploaded one for this last year. And you're like, oh, all right. Or no, I closed that. Like, so if they don't know to ask for it, you got to make sure it's on your checklist. But also, why did you need an extension? Like, sometimes, hey, CPA could be brutally honest. We got crushed. So-and-so was out on maternity leave. Like, whatever. Somebody had surgery. Life happens, right? We're going to get it done as soon as possible. Don't worry. And then just make sure you're organized. Like, I have a folder. I have a digital folder. You have the email. Like, a lot more and more things are just coming in electronically. So you got to make sure you have all those uploads. So have your own checklist. Have your CPA get a checklist. But this also goes back to the fact that, hey, in October, you probably should have gone through a rough one on this. Hey, what do we have for capital gains here? Like, you should have seen the rough ending of this in October. You shouldn't be punched in the mouth end of March with a tax surprise.
Okay. All right. That makes sense. And, it seems like the theme of this podcast is planning.
Yes. Poor planning does not make an emergency on my end.
Yeah, and you'd be swearing under your breath, or maybe you'd just be swearing at me, because I have to admit I am a poor planner, especially when it comes to taxes.
Yeah, but if people were better planners, I wouldn't have a job. When if finance was easy, I wouldn't have a job.
All right, so we're talking about planning. Let's
bring this one in. Bring this airplane in for a landing.
Yes, let's wrap this up.
So future tax planning, like, that goes back to, all right, what happened? Let's do the postmortem of what happened in 24. What do we think is going to happen in 25? And what can we change? That's why tax planning basically starts once your taxes are filed. Once they're filed, we can see what happened. Then let's look at your W-2 halfway through the year. Did you get a raise? Did you get a bonus? Did you sell a rental property? Did you get some type of inheritance? Like, you get clients that, hey, people are getting older, people are passing away, they're inheriting. They talk about the great wealth transfer. Like, you need, be it, hey, if it's not me, make sure it's either a CFP with some tax expertise or your CPA. A lot of CPA firms, it's an add-on service to do tax planning. A lot of them will do your tax preparation, but tax planning is like that next step. Or some of them include as the add-on, but you got to ask for it. Like, say, I want to set this up. I don't want to have a surprise like this again. What can we do? You tell that to a CPA and they say, hey, Godspeed, or just withhold more. Like, understand why. Like, where'd you fall in that tax bracket? Where did some of these things, what changed from 23 to 24? Like, that's always my fun part of looking at my tax return is, like, Mark has been doing my taxes for 20 years. Like, he says, hey, like, you did better, you did worse. There was more of this type of income, that type of income. And suddenly you have more stuff. And this is more income. You had to hit another bracket. So we got to adjust for this. Does it make sense to buy a office versus like renting one? Should you buy that vehicle? Do you max super fund your retirement account? Those conversations start basically April 16th.
Very good. Very good. Thanks, Nick. How about we get some contact information so people can get even more info from you?
No, you can go stgeorgewealth.com, Nick at stgeorgewealth.com. You have Facebook, LinkedIn, they're all clicked in there. Hopefully, if you don't have someone to do this with and you don't want me to do your investment management, I have plan only billing. Like, it's not all or nothing. If you love doing your own investments or that sort of thing, pay for the financial plan. Say, hey, I need to understand where I'm at. Maybe you don't need this every year, but you got to a point with everything like that. Book the 20-minute Ask Me Anything. Let's just see if it's a good fit or if you even need it. Maybe you just have one or two questions, but don't be bashful. Click it. Those links are all over this podcast, the website. I am not hard to find. I'm 6'5", 3 and too much pounds. Like, Coach Fluffy's out there. You can find me.
All right, Coach Fluffy, thank you. Appreciate that. And we're looking forward to your next podcast. And thank you for listening to today's Unf Your Finances podcast. Please like, follow, and share this podcast with friends and family. Until the next Unf Your Finances podcast, I'm your producer, RJ Mallett.
Thank you for listening to the Unf Your Finances podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.stgeorgewealth.com or give us a call at 828-481-8836. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of St. George Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA and SIPC. Any guests and their company or companies are not affiliated with or endorsed by LPL Financial unless otherwise stated. Individual tax and legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee for future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.